In the heart of Mumbai's bustling financial district, a scandal was brewing that would shake the foundations of India's largest stock exchange. The National Stock Exchange, or NSE, had long been the crown jewel of India's financial markets, handling billions of dollars in daily trades. But beneath its gleaming facade, a sinister scheme was unfolding. One that would exploit the very technology meant to make markets fairer and more efficient. Let's rewind to 2010. The NSE, in a bid to modernize its operations, introduced colocation services. This allowed brokers to place their servers physically closer to the exchange's systems. On paper, it seemed like a step towards a more advanced, competitive market. But in reality, it opened the door to a world of unfair advantages and manipulated trades. Picture this. Rows of servers humming in a climate-controlled room, mere meters away from the NSE's main trading engine. These weren't just any servers. They belonged to a select group of brokers who had paid a premium for this prime real estate. But why would anyone pay extra just to have their computer a bit closer to another? The answer lies in the world of high-frequency trading, or HFT. In the blink of an eye, these co-located servers could receive market data and execute trades faster than their competitors. We're talking microseconds here. But in the world of algorithmic trading, that's an eternity. Imagine a race where some runners get to start a few steps ahead of the line. That's essentially what was happening in India's biggest stock market. But how exactly did this translate into an unfair advantage? Let's break it down with an example. Trader A, with a co-located server, receives information about a large buy order for Company X's shares. In the milliseconds before this information reaches other traders, Trader A's algorithm quickly buys up available shares of Company X. When the large order hits the market and drives up the price, Trader A sells their newly acquired shares at a profit. This practice, known as front-running, is illegal. But the speed advantage made it nearly undetectable. As we dig deeper into this technological rabbit hole, a troubling question emerges. How could such a blatant abuse of the system go unchecked? The answer, it seems, lies in a perfect storm of lax oversight, conflicts of interest, and alleged collusion at the highest levels of the NS. Timeline graphics flash across the screen, highlighting key events. 2010. Co-location services introduced at NS. 2015. First whistleblower complaints emerge. 2016. SEBI begins investigation. 2018. CBI launches probe into co-location scam. News headlines scroll by, each more damning than the last. NSE co-location scam. The inside story of India's biggest market manipulation? Former NSE CEO arrested in co-location case? SEBI imposes hefty fines on NSE officials in co-location case as investigations by the Securities and Exchange Board of India SEBI and the Central Bureau of Investigation CBI unfolded. A web of alleged misconduct came to light. NSE officials were accused of providing preferential access to certain brokers, allowing them to connect to specific servers that had faster access to the exchange's data feed. Internal emails and forensic audits painted a picture of systemic failures and deliberate oversight. But the rot went deeper than just technical advantages. Allegations surfaced of NSE officials sharing confidential information with select brokers, giving them insights into the exchange's order matching logic. This wasn't just about faster connections. It was about having the blueprint to the entire system. The scale of the profits made through these unfair practices is staggering. While exact figures are hard to pin down, estimates suggest that the illicit gains could run into hundreds of millions of dollars. But the true cost goes beyond just money. The very integrity of India's financial markets was called into question. Investor trust, the lifeblood of any stock market, took a severe hit. How could ordinary investors compete in a market where the deck was so heavily stacked against them? The NSE co-location scam wasn't just a technical glitch. It was a fundamental breach of market fairness. As the scandal unfolded, it became clear that this wasn't just a failure of technology, or even just of individuals. It was a failure of governance on a massive scale. The NSE, meant to be the guardian of market integrity, had become the facilitator of its manipulation. The repercussions of the scandal spread far beyond the confines of the NSE. Regulatory bodies faced harsh criticism for their delayed response and perceived leniency. Calls for reform echoed through the halls of power in Delhi and the trading floors of Mumbai. In the wake of the scandal, SEBI introduced a slew of new regulations aimed at leveling the playing field. Colocation services were overhauled with stricter monitoring and more transparent allocation processes. But for many, these measures felt like too little, too late. The NSE colocation scam serves as a stark reminder of the challenges facing financial markets in the age of high-speed algorithm-driven trading. As technology continues to advance, regulators and market operators must remain vigilant, always one step ahead of those who would exploit the system for unfair gain. Looking to the future, the scandal has sparked a broader conversation about market structure and fairness. Should colocation be allowed at all? How can regulators keep pace with rapidly evolving trading technologies? These are questions that will shape the future of not just Indian markets, but financial markets worldwide. As we conclude our investigation into this complex web of technology, finance, and alleged corruption, one thing becomes clear. The NSE colocation scam is more than just a cautionary tale. It's a wake-up call for markets around the world. In the race for faster trades and bigger profits, we must never lose sight of the fundamental principles of fairness and transparency that underpin our financial systems. The story of the NSE colocation scam is far from over. As investigations continue and court cases unfold, the full extent of the manipulation may yet come to light. But its impact is already being felt, reshaping India's financial landscape and serving as a stark warning to markets around the globe. In the high-stakes world of modern finance, where milliseconds can mean millions, vigilance is not just important, it's essential.